you know, 3250 is our year-end target, right? So we've been pretty explicit that we think we can trade 3,500 in the first half because of the liquidity that's plowing into the market. So back in November, I think we were here last time in September, we said, look, if things change, we'll change our view. And we did. We raised our targets and we said we're going to have a liquidity-driven bull market into the first half of next year. And so we raised our target to 3250 for bull, and we said we'd get there probably in short order. And we have. And we got there faster than we even thought, quite frankly. 3,500 we talked about in the last month and a half ago is a target for the first half of this year. What we're concerned about in the back half of the year is that the liquidity will start to be drained because the Fed will no longer be expanding their balance sheet along with other central banks. And we will have politics to maybe be concerned about. And we'll have to look forward to 2021, where there'll be more uncertainty again about the sustainability of a late cycle environment, right? There's no recession, right? The late cycle expansion has been extended. The Fed got in front of it. They're very aggressive. The yield curve re-steepened, and we changed our view on that. But that doesn't mean that the fundamentals are driving this momentum. It's more about the liquidity, and the fundamentals improved. But it's hard to argue that there's going to be enough earnings growth to justify the move that we've had in the last 3 or 4 months. To me, it's about liquidity and the fact that the fundamentals stabilized. And so people are buying high-quality liquid names.
What kind of earnings growth do you need for the market
I think you need 10% to see the 3,500 to be sustained.
That
and
much?
Then further.
10%?
Yeah, I think you need 10% this year. I think we're going to get more like low single digits now, 2 or 3%. We were at 0. Our models are coming up a little bit. And so that's what the market's going to have to deal with in the back half of the year. I think it's pretty clear the market is still buying somewhat defensively oriented stocks. Look, Microsoft and Apple are the highest quality stocks in the marketplace. We love Microsoft. We just raised our price target today to the highest on the street. It's expensive, but so what? If there's liquidity, it's the highest quality name in the marketplace, and that's what people are going to continue to buy.
Apple's a defensive name now?
Apple is a high quality name, okay, not defensive. Remember but the market is paying for quality growth, and that's what we want to pay for too. We think high quality, large cap growth is what the market wants, and that's what the market's going to continue to buy.
By the way, Apple, as we speak, hits $301. That's a new all-time high for Apple as well. I look at the picture. I feel like the economy is just fine.
Yeah,
okay,
I agree.
The Fed, you say, okay, they're QE or whatever is going to end. They're still going to be there, though.
That's
right.
They? They're going to be there, but they're not going to be pumping money into the system.
How do you know?
Well, we don't know. That's a fair point. So we will adjust our view again for back half of the year. Who cares what happens in the back half of the year? I'm focused on the next 6 months right now, right? And we're bullish on the next 6 months for a lot of different reasons, not just liquidity. Look, the fundamentals have improved more globally than they have in the U.S. so far. Most of the incremental improvement in PMIs has been in China and in Europe, not so much in the U.S. yet. We think that'll follow. The U.S. will be a laggard in the recovery globally. Okay, we've also had sentiment improve. Obviously, it got too bearish in the summer. We got valuations were cheap. And we've corrected that. That's where we are now. And I could argue the market's fairly priced today, but we think it will overshoot because of liquidity primarily.
What happens if it looks, okay, let's say the first half of the year, I think most people agree is the more sanguine part of the year. You don't have much in front of you, and then you get past this into the summer, you have to start thinking about the election. That's when you think it could get a little rocky.
Potentially.
What happens if it looks like the president's going to get reelected?
That'll be positive. But we don't know that right now, right? So who cares?
Well, isn't that you deal with base and bull and whatever case? Right. Is it the base case right now is that the president gets reelected?
The base case
Don't
is
you
the president.
Think?
Yes, I think that's right. With some consternation in the back half, not knowing what the answer is going to be. And if the president gets reelected, yes, maybe in December we have a big rally on that. But then we got to look forward, Scott, into 2021. Okay, we can agree that the economy is late cycle. Would we agree with that? I mean, the unemployment's at 3.5%, the lowest in 50 years, and it could fall further. But if it falls to, say, 3.2 or 3.1% by the end of the year, does that raise the risk then of an unemployment cycle, or does it lower the risk? I would argue it probably raises the risk again. So your risk premiums have to go back up, and your multiples come down. That's all we're talking about. Multiples come back down to a more normal level, 17 times from 19 times.
So, Mike, I have a question. If you're assuming that the market, your base case is that the market by the end of the year, by the end of this year, is down 7%. I mean, that's what the numbers said. That implies you have flat earnings, or you must assume that the economy really weakens, that we're either in a recession or heading into recession, because if the market grows in consensus, I think, is for earnings to grow 8-9% this year, at that price, the market would be trading at 15 times earnings. So in order for there not to be a very attractive buying opportunity, earnings have to be coming down. So you've got a much more negative view on the economy than I'd say I do.
It's not so much the economy. The economy is decelerating this year from last year. I think the consensus view is that we're going to decelerate to
we had flat earnings. We had flat earnings.
Correct.
2019. And you're assuming flat earnings in 2020, which I think isn't it more negative than?
We're assuming about 2 or 3% growth for this year from last year. Last year we predicted 0% earnings, and it was 0% earnings. The model now is saying 2 to 3%. Right. So
congratulations.
What's your progression on that 2 to 3% by quarter? Well, are you seeing the first quarter is going to be up 5%, the second quarter up 7.5%, and then we're down in the next 2 quarters?
It's going to be sort of flattish throughout the year unless there's an acceleration in growth beyond the 1.8% so we get more top line or costs get under control. The bigger question that we have, and the way we think about the market is basically there's not only income inequality, okay, in individuals, there's corporate income inequality, okay. So our call for an earnings recession is more predicated on small mid-cap companies. That's where the quality is lower, right? And that's really where we're focused right now. We're not so focused on price targets for year end, okay? That's not how you make money. We're focused on the next 6 months. We're focused on what's the market going to like right now, what's the market not going to like right now.
So on that point, it's exactly where I wanted to go. I don't understand how you think the market can get to 3,500, but you're underweight the biggest part of the market, which is tech.
Yeah.
That doesn't make sense to me.
We're not underweight the entire sector, right? So we own high-quality tech within that, which could be the largest market cap companies, okay? For example, Microsoft, which is a name we've had on the list for 18 months. So underweight, overweight doesn't mean you don't own anything, okay? You could own the better performers within that, as an example.
But you don't have a wholly positive view on tech.
No, we think tech has a higher propensity of risk because it's crowded. For the average company, once again, we're talking about the average company within the sector. Remember, equal weight versus market cap weight is very, very different. So we look at our sector weights as what's the best fertile ground for picking stocks from an average stock perspective.